Good evening, everyone. In November of 2025, something happened that nobody saw coming. XRP ETFs pulled in 906 million in 14 days, not weeks, not months, 14 days. That's fast, faster than Bitcoin's ETF launch, faster than Ethereum's. And here's what makes it absolutely insane. This has nothing to do with crypto speculation. What you're witnessing is the complete rebuilding of the global monetary system. And if you don't understand what's happening right now, you're about to get left behind. Let's talk about what just happened with XRP, because the mainstream media is completely missing the story. Between November 13th and December 6th, 2025, of course, XRP spot ETFs attracted 906 million in net inflows. To put that in perspective, that's approaching $1 billion faster than Bitcoin or Ethereum managed during their ETF launches. But here's what you need to understand. This wasn't the crypto bros buying the hype. Look at the numbers. 70% of this capital came from institutional investors, Wall Street, asset managers, the same people who called crypto a scam 2 years ago. Why? Because they understand something most retail investors don't. XRP isn't trying to be digital gold like Bitcoin. It's not trying to be the world computer like Ethereum. XRP is a settlement infrastructure for the next generation monetary system. And after Ripple's 125 million SEC settlement removed regulatory uncertainty, institutions immediately recognized the opportunity. We're talking 19 consecutive days of ETF inflows as of December 11. Now, if XRP's institutional adoption didn't convince you something massive is happening, let me show you what JPMorgan did. On November 12th, JPMorgan launched the JPMD token. That's their tokenized deposit product on Coinbase's Base blockchain. Let that sink in for a second. The largest bank in America just put real USD deposits on a public Ethereum Layer 2 blockchain. Not a private permission ledger, not some closed banking network, a public blockchain that anyone can verify. Every JPMD token represents $1 US sitting in a JPMorgan deposit account. Now their institutional clients can move those dollars 24/7 instantly, peer-to-peer, without waiting for banks to open or SWIFT to process. Now here's the kicker. McKinsey projects that by 2030, tokenized bank deposits could support 100 to 140 trillion in annual payment flows. That's not a typo. That's rivaling and surpassing the entire traditional payment system as we know it today. So we've got XRP seeing massive institutional inflows, JP Morgan tokenizing deposits, but where is all of this headed? The Bank of International Settlements is basically the central bank of central banks. They released their vision in June of this year, and it's crystal clear. They laid out the blueprint for next generation monetary system, and it has three core components: tokenized central bank reserves, tokenized commercial bank money, and tokenized government bonds. All three operating on a unified ledger, essentially a programmable blockchain where these different forms of money can interact seamlessly. Now, the BIS identified three critical tests this system it has to pass. I'll go over them in just a second. Number one, singleness, ensuring all forms of money settle at par with central bank reserves. Number two, elasticity. The system must be flexibly provide liquidity for large payments. And number three, integrity, protection against financial crime. Now, here's what most people don't realize. Current stablecoins like USDT and USDC currently they may be failing the test, particularly the singleness. We're going to look into that just a little bit further. So, if we dive deeper into the singleness, because this is one of those critical concepts everyone is ignoring. Singleness means that $1 in any form, cash, bank deposit, tokenized money, should always be worth exactly $1, no deviation, no trading above or below par value. In traditional banking, this works because all commercial banks settle their obligations using central bank reserves. If I pay you and we bank at different institutions, our banks settle the transaction using reserves at the Federal Reserve. Those reserves are the base layer that guarantees the singleness. But stablecoins, based on BIS research, shows that they often trade at varying exchange rates. Tether has traded as low as 88 cents and as high as 105. That deviation might seem small, but it's a fundamental violation of what money is supposed to do. This is why the future isn't private stablecoins. It's tokenized central bank reserves and tokenized commercial bank money, both backed by the same reserve system. Now, that's worked for decades. Now it'll be programmable on blockchain infrastructure. Now let's talk a little bit about elasticity. This is the second critical test. In traditional finance, when commercial banks need more liquidity, they settle large payments. They can borrow from central banks' discount window and use other lending facilities. The money supply expands when the economy needs it and contracts when it doesn't. The elasticity is what prevents payment gridlocks. Imagine if every time a major corporation needed to make $1 billion payment, they had to wait for physical cash to be delivered. The economy would freeze. Tokenized systems face the same challenge. How do you maintain elasticity on a blockchain? The solution to that, tokenized central bank reserves that commercial banks can access through automated smart contracts. When Bank A needs liquidity, they can instantly access tokenized central bank reserves, make their payment, and settle all atomically on chain. This is why the BIS blueprint puts central bank reserves at the center of that system. Without that elastic base layer, tokenized money can't scale to support a $100 trillion economy. So, while Americans debate whether crypto is legitimate, other countries are already using tokenized money. On November 17th of 2025, the UAE completed their first government transaction using wholesale CBDC on the mBridge platform. So what is the mBridge, right? It's a multi-central bank digital currency platform connecting 5 countries: China, Thailand, Hong Kong, UAE, and Saudi Arabia, for real-time peer-to-peer cross-border payments. No SWIFT, no correspondent banks, no 3-day settlement times, just instant atomic transfers of tokenized central bank money between countries. Now, get this. According to the Atlantic Council's CBDC tracker, 137 countries representing 98% of global GDP are exploring central bank digital currencies. Over 70 are in advanced phases, with 49 in pilot programs currently running. China has already processed 7 trillion yuan. This isn't a pilot anymore. This is production. Let's briefly talk about the Genius Act versus MiCA. Now, all this tokenization requires regulatory clarity. In 2025, we finally got that. In July 18th, the United States passed the Genius Act, the first comprehensive federal stablecoin legislation. Meanwhile, Europe passed the MiCA regulation, and that came into full effect. Here's the difference. The Genius Act allows both federal and state regulatory approaches, giving stablecoin issuers some flexibility. But it requires a one-to-one backing with high-quality liquid assets, no fractional reserves or rehypothecation. MiCA takes a stricter approach, emphasizing consumer protection and operational resilience. European stablecoin issuers must meet reserve requirements, regular audits, and stringent operational standards. Both frameworks recognize one critical principle. Stablecoins are too important to remain unregulated. They're becoming the base layer for tokenized finance, and governments needed to establish those guardrails. As a result, we have Ripple's RLUSD stablecoin, and then we have Circle's USDC, and other compliant issuers can now operate with legal clarity in the world's two largest economies. Speaking of regulatory clarity, let's talk about Ripple's RLUSD stablecoin and the launch in Japan. In August of 2025, Ripple announced a partnership with SBI Holdings to distribute RLUSD in Japan, starting Q1 of 2026. That's just around the corner. SBI holds an electronic payment instrument exchange service provider license, making this launch fully compliant with Japanese regulation. Why does that matter? Japan represents over half of Ripple's business, and Japan just became the first major market to approve a foreign stablecoin under its 2025 revised Payment Services Act. This isn't speculation. This is a licensed, regulated, institutional grade stablecoin entering a $300 billion market. Here's the strategic angle here. RLUSD on the XRP ledger enables instant cross-border settlements between Japan and other markets. Japanese companies, can send RLUSD to partners globally. They can settle instantly and avoid the 3-day wait times and fees of traditional banking. Here's a key insight. Asia is moving faster than the West on stablecoin adoption. Japan's regulatory approval, combined with SBI's distribution network, positions Ripple as a major competitor to USDC and USDT in Asian markets. We'll continue to monitor that. Now, while everyone's focus is still on XRP's price and stablecoin regulation, there's a silent giant growing in the background. Real-world asset tokenization just hit 25 billion in early 2025. That's a 63% jump from January 2024. Now, analysts project that this market will reach 18 trillion by 2033. So, what are real-world assets? Again, everything from government bonds to real estate to commodities to traditional assets. All of that is being represented as a token on blockchain platforms. Now, just yesterday, JPMorgan arranged a tokenized commercial paper issuance. That's right, a tokenized commercial paper issuance on Galaxy Digital on the Solana blockchain. That's traditional Wall Street bank using a public blockchain to issue corporate debt. Ripple and Archax are targeting a $1 billion in tokenized assets on the XRP ledger by mid-2026. That's massive. BlackRock has launched the Biddle Fund, a tokenized treasury product. Franklin Templeton has a tokenized money market fund. This isn't crypto disrupting finance. This is finance becoming crypto. The key insight here is that RWA tokenization represents the bridge between traditional finance and blockchain infrastructure. As regulatory clarity improves, we can basically expect an explosive growth. Traditional assets benefit from the 24/7 trading, fractional ownership, and programmable compliance. I hope that you enjoyed this session. Have a good evening and take care.